mega cap earnings are going to be driving the day here this morning. Futures are pointing higher, absolutely. Markets are very extended here above basically every moving average. Here's what you need to know before the bell this morning. From a bullish perspective, all these moving averages are now sloping higher. Remember that the slope of the moving average is what tells you the direction or trend of the markets. And those that are now on all of these, including the 200-day, the 100-day, the 50, and the 20, are now sloping higher on those moving averages, telling you that the trend to the market is positive for the time being. However, as we've been talking about, the deviations, we've been going through this for the last several weeks, the deviations from these moving averages are rather extreme, and so you're going to get a correction. Now, I wouldn't expect one until after we get past earnings. Right now, earnings are providing that bid under stocks, and we've been talking about that. Now, interestingly enough, talking about the bid under stocks, stocks that are beating estimates are not being all that well rewarded, right? Netflix posted good earnings, strong subscriber growth, stock was down. That was just one example, but there's been quite a few like that. And even stocks that are trading higher after beating earnings aren't really trading dramatically higher. We're not seeing those big 20% surges of companies after they beat earnings. So again, that tells you that probably a lot of what is happening in the market has already been priced in by the previous advance of the market. So now it is basically companies meeting expectations of the markets. Markets going, okay, yeah, I was already here ahead of you. And now that's why you're not getting a lot of bid. Nonetheless, though, these deviations are unsustainable over time. So you're going to get a correction that probably won't happen until September as we get past summer and really kind of August, September. That's where the most likely opportunity here is for a correctional process in the markets that are going to lead to an opportunity to add some equity exposure. And again, there's nothing bearish about this market right now, so we want to use dips to add exposure to portfolios, particularly heading into the end of the year, until and unless we begin to see that change where the lag effect of all these policies are starting to erode earnings growth. If that occurs, then this will all change. But right now, it's bullish, so we need to participate in the market short term. So using dips to add to equity exposure to portfolios is the most logical thing to do for right now. Again, just keeping in mind on what the trend of the market is versus what we expect to happen. We'll deal with that when it occurs. But that's what you need to know before the bell this morning.